Hello, and welcome to another edition of Econ Updates. I'm Steve Taddie, Director of HoyleCohen Wealth Management. Today's October 21st, and economic data continues to show higher growth and lesser inflation than initial expectations. What many are calling U.S. exceptionalism has resulted in a spate of improving forecasts. Economic growth standing on the platform of continued healthy wage gains and portfolio income gains from both the employed and invested consumer continue to drive economic activity. For 2024, expectations from the National Association for Business Economists show a 2.6% growth rate. Now, that's less than the 2.9% growth experienced in 2023. And looking forward, that same group calls for economic activity in 2025 to come in under 2%. For inflation, the rate of change has continued lower. And using recent month-over-month inflation data, and more specifically, the average month-over-month increase for the last 3 and 6 months, we can see a path towards 2% or less inflation for the next 12 months. Of course, all else being equal. Within the stock market, participation is broadened, not only within the S&P 500, but with smaller companies within other U.S. indexes as well. In fact, earnings forecasts accumulated by FactSet show faster growth rates for the mid and small cap companies than the S&P 500. And more recently, stock gains of the mid and small cap companies have bested that of the S&P 500. Price earnings ratios for the S&P 500 come in at about 21 times earnings, compared to roughly 15-ish for both the mid and the small cap companies. Earnings per share growth, however, is showing under 15% for the S&P 500, over 15% for the mid-cap companies, and around 18% for the small-cap companies. So we've got a case of a lesser valuation for the smaller companies and comparably higher earnings per share growth for the smaller companies. Within the bond markets, the 10-year U.S. Treasury has traded in a range of between 3.5% and 5% since roughly October of 2022. Now, since April of 2024, the rate of the 10-year Treasury has fallen from 4.7%, bottoming out at about 3.7% in September of this year, to rise from mid-September to present to about 4.15%. A healthy increase, but a lot of that reflects less of a flight to safety and lesser of a concern about a hard landing in the U.S. economy. Treasury yields have proven to be a bit more volatile than corporate yields, as the spread, or the difference between the two, has narrowed as Treasury rates have risen at a faster rate than corporate rates. Outside of potential black swans, and there's always that potential, two of the more important issues to watch are the jobs data and Federal Reserve action. So leading up to this month, the jobs data has been weakening every month that went by. For example, 2024 year to date as compared to 2023 showed 20% fewer jobs created in the U.S. On top of that, there were revisions to the initially reported data by the Bureau of Labor Statistics, and that data showed 10% negative revisions in 2023 and 22% negative revisions in 2024. Now, the September data showed a reversal and a positive revision. Now, is it a turning point? 1 month is not a trend, so stay tuned on the jobs data going forward because it is important to our economy as it plays right into the strength of the employed consumer and their wage gains, and plays into what's going through the minds of the Federal Reserve governors when it comes time to vote on interest rate actions. The path of the Federal Reserve, it looks like there's 2 more rate cuts in the offing for this year, one in November and one in December. The November rate cut will be after the election, so it would be considered non-political. And all else being equal, there would be 4 more rate cuts in 2025. Of course, that is the forecast of economists on what they see right now and today in the economy and from what they've read on the tea leaves from the Federal Reserve governors. If that were to happen, that takes the Fed funds rate to 3.5% by the end of 2025. There remains a lot of noise related to the size and the timing of the cuts. But with the long and variable lags involved, with respect to monetary policy, it seems that the destination is more important than the turn-by-turn path to the destination. With the 10-year Treasury trading at about 4.15%, it doesn't take but a few more rate cuts to the Fed funds rate to get us to a more normalized curve, which, all else being equal, we would expect to see in the first part of 2025. Now, the stock markets have priced in a more predictable environment and seem to have priced in a number of positive outcomes. That's where we see the markets and the economy right now. I thank you for tuning in and have a great rest of your day.